Hello and welcome. My name is Brandon Graef, and I'm joined by Jeff Seedall and Evette Daley. We've decided to do our financial analysis on Nordstrom Incorporated. Nordstrom is a leading fashion retailer that has been operating since 1901 and is currently headquartered in Seattle, Washington. They are a publicly traded company and are listed on the New York Stock Exchange. Today, we're going to spend some time to go over the basic strategy and risks for the company. We'll also spend some time discussing our findings based on their 10K annual report. In this case, we're looking at 2018. And then we'll do some competitor analysis with another leading retailer in the industry. So with that being said, let's begin. Nordstrom's annual report was full of strategic plans, but above all else, and what stood out to us the most was their focus on providing the customer with a superior shopping experience. Now, this day and age, it's a given that retailers have to offer good customer service, but what Nordstrom has done is taken it a step further by considering the customer's actual experience or perception of the service that Nordstrom is offering. Nordstrom also understands the importance of online retail, which is why they focus on making that process as easy as possible for the customer. They do this by offering a simple user interface as well as offering free shipping and free returns. Also, like many other retailers, Nordstrom has a rewards-based loyalty program for their members who have signed up to be a part of their Nordy Club, as they call it. This program incentivizes the customer to spend more by rewarding them with additional offers and discounts on future purchases. Nordstrom's also very well known for their annual anniversary sale. This is a great way to draw in new as well as return customers. This program ties in nicely to their Nordstrom branded Visa reward card by allowing cardholders early access to the sale. And it's worth mentioning that the Nordstrom Visa card has actually proven to be a strong source of revenue for the company, and it's going to continue to be one of their main strategies going forward. Lastly, they understand that they've got a strong brand name, and so they're going to do everything they can to leverage that through effective marketing and advertising for the company. Next, we're going to take a look at some of the risks that the company faces. Despite their strategic initiatives, Nordstrom understands they do face some risk. We've listed a handful here, but most of the risk they face has to do with keeping up with customer demand in an ever-changing retail climate. Above all else, they need to make sure that they're able to adapt and that they don't fall behind when the customer preference or consumer behavior changes. They also need to make sure that they've got a process in place for business continuity in the event that they run into any system failures or other network disruptions. So next we'll begin discussing more of the data side of the annual report. In order to analyze the data, we used an equity valuation and analysis tool called eVal. And this is provided to us by Lundholm & Sloan. We found that the data set provided for Nordstrom was very clean, so to speak, and it made it easy to translate into the eVal tool. In fact, we didn't have to manipulate the data at all, which made us feel good. We were confident that there'd be less room for error or misinterpretation on our part. So with that being said, I'm now going to hand it over to Evette, who's going to discuss some more of our key findings.
We analyzed Nordstrom's key accounting policies, and we found that they really have four main policies that they use. The first is revenue recognition, and sales revenue is recognized net of estimated returns and excludes sales tax. Nordstrom recognizes revenue from direct sales to customers from stores and fulfillment centers, which are mainly from online sales, which includes shipping revenue when applicable. And this is recognized upon the estimated arrival to the customer. The customer merchandise returns are estimated based on historical return patterns and what consumers have done in the past, in which sales and the cost of sales are adjusted accordingly. Next is merchandise inventory. And Nordstrom uses the retail inventory method, which means that merchandise inventories are stated at the lower cost of market value. And the retail inventory method uses a calculated cost to retail value of ending inventory to determine valuation. Then the value of their inventory on the balance sheet is reduced by a charge to cost of sales for inventory markdowns. Third is goodwill, which is reviewed annually to make sure carrying cost does not exceed fair value. This is done through a two-step fair value test. Step one includes comparing the estimated value to the carrying cost value, which is compared based on the present value of future cash flows. And this is the income approach. Or they compare public companies and acquisitions, and this is the market approach. And sometimes they will use a combination of both the income and market approaches. The second step is used to quantify the amount of the impairment if fair value is lower than carrying value. And Nordstrom's last key accounting policy is their income tax expense, and they use the asset and liability method for realizing income tax expense. Nordstrom's reported earnings are a pretty good reflection of their overall performance. The report is very transparent, and they seem to have a very straightforward accounting method and way of reflecting the true values on their financial statements. As a well-established company within their industry, Nordstrom's growth and economic performance is observable within their report, and there were no indications of misleading or manipulated information. Next, we analyzed Nordstrom's return on equity, and they had a 0.407 return on equity. And we broke that down into RNOA and leverage times spread. And their RNOA identifies the piece of ROE that is attributed to operations, and Nordstrom gained 11.43% of the return on equity from operations. The leverage and spread represent the piece of ROE that is attributed to finance, and Nordstrom gained 29.16% of their return on equity from financials. So this means that whatever Nordstrom is doing in their financial department, they're doing very well, and they have a good strategy of what they have a vision for. We chose Macy's as the key competitor to compare to Nordstrom, and we found that Macy's had a return of equity of 0.146, and we also broke that down into RNOA and leverage and spread, and we found that Macy's gained 7.4% of their return on equity from operations, and we also found that 7.3% of their return on equity from financials. So neither of these were as good as Nordstrom. Macy's has significantly higher common equity, net financial obligations, net financial expense, and net operating income. They also have a much larger amount of long-term debt, deferred taxes, etc. So overall, Macy's has a higher amount of total assets, total liabilities, and total equity than Nordstrom does, but Nordstrom generates a greater return on equity from both their operations and their finance. I will now turn it over to Jeff to talk about more of the analyses that we performed.
Thank you, Evette. Thank you, Brandon. As part of our analysis, we did some marginal comparisons between Nordstrom's and Macy's. As you can see on this slide, that Nordstrom and that both companies have very similar ratios, with differences only being in the thousandths or 10,000ths decimal points. This led us to believe that these are pretty common ratios for the industry. We counted the gross margin and net operating margin being higher for Macy's due to the greater assets and quantities that Evette just mentioned. But we believe that their financial statements are pretty close based on the earnings before income tax margin and the earning before income tax depreciation and amortization margins. So keep in mind how close these numerically are as we go through some of the turnover analysis on the next slide. So as we broke down the turnover between the two companies, like Evette said, Nordstrom gets a lot more of its revenue based on its financing and on operations. And you can see this here in the turnover ratios. The net working capital turnover is much greater for Nordstrom than for Macy's, which is an indicator that their operations and their capital are greater sources of revenue. If you focus on the average days to collect receivables, their inventory holding, and their days to pay payables, Nordstrom's cash flows move much faster in and out of the company than for Macy's. And so this was just an interesting fact to us that how much money Nordstrom must move in comparison to Macy's. The other part that we found interesting was that the average inventory holding period is less than half of what Nordstrom likes to have on hand. Just as a principle of a company, they like to have 6 months worth of inventory prepared. But this average holding period shows that they go through this 6-month period twice, or they go through their inventory twice within the 6-month period. So those were some of the figures that stood out to us. The other thing is the PP&E. I think we believe this was higher because Nordstrom has begun spreading their Nordstrom Rack chain stores throughout the United States, and they also have a large amount of stores of just the Nordstrom brand stores themselves. So on the next couple slides, we'll see some of the cash flows that they use to pay off stockholders. So as we see here, the free cash flow to common equity, this is the amount of money that Nordstrom generates from its revenues that can go to common equity holders. Although this is just a single digit or a single numerical value, the trend for this would be what investors would want to look at. This quantity represents $73 million that Nordstrom would be able to pay out to anyone holding their common stock. And so if this number has continued to grow over the past 3 to 5 years, this would be a comfortable investment to make, knowing that you will get a return on your investment. On the next slide, we'll see more about what is given to the stockholders. So common equity was $73 million. The free cash flows to investors is $166 million. The difference is that this cash flow would be what is given to the company's investors as cash dividends or another form of reimbursement. Once again, though, you'd want to see what trend there's been in this number, whether or not being a full investor in this company is going to give you a return. So on the next slide, we will see what Nordstrom has done with its capital. So the largest use of cash flows for Nordstrom has been capital expenditures at $731 million. Because this is still a brick and mortar like store that involves having a lot of retail space, having a lot of warehouses to hold inventory, offices, etc. It's no surprise to us that this is their largest cash flow. Their next at $661 million was payments on long-term borrowings, whether this is mortgages on real estate, whether it's just a long-term debt of some kind. This cash flow is just to pay off its any kind of long-term debt financing. Next would be $247 million in cash dividends, which you can see from the cash flow to common equity and cash flow to investors on the previous 2 slides. The $211 million of repurchasing common stock. It's likely that Nordstrom's investors or board members decided that they wanted to adjust some kind of ownership ratio or wanted to change their stock price, so they spent this money to influence their capital structure. The last $174 million in this year went to increase cash surplus. So overall, 2016 to 2017 was a very healthy year for Nordstrom. This concludes our financial analysis of the company and the industry, and we thank you for watching.